Well, we are coming up on the conclusion of our ninth annual Community Banking in the 21st Century Research and Policy Conference, and I'm delighted to introduce John Ryan, who's going to provide us with his thoughts as he wraps up our two-day conference here. As you all know, John is the President and Chief Executive Officer of the Conference of State Bank Supervisors, and John was one of the original proponents, advocates, really one of the main forces behind this conference when things, I think conversations started in 2012 and we were able to offer this in 2013. And so, John, we appreciate all of your leadership throughout this, the entire life of this conference, and so happy that you can join us today. Thank you.
Thank you, Jim. And I'd also like to extend thanks to you. Jim Fuchs has been really the glue and a driving force, and it's not easy to be glue and a driving force of this conference and of all of us to make this happen. So I also want to thank all of you participants. We say this every year, but something that makes this conference unique is how it pulls together academic researchers, community bankers, practitioners, industry practitioners, and regulators, and creates space for discussion. All of your work and your participation, whether you're a researcher, a community banker, a student, a regulator, what you're doing and coming together is unique, and it makes a difference. And I think it makes for better public policy that's essential to how our economy functions, how our democracy functions. So I think about the challenges that we've faced in the last 18 months, and it really does remind me of why we started this event in the first place and why it matters, why we thought it would matter back 9 years ago, and how I see that it is delivering on its promise and value. And there are lots of different stories I can tell, but I'm going to tell you what at least I observe as kind of a tale of two treasuries in their response to very different crises, but that I think has been informed in some ways by the work that we've been doing over the last 9 years. So certainly what I was thinking back in 2012 and even earlier was that I was hearing from great concern from the state regulators that I work for about the threat and loss of diversity of financial institutions and what it meant to lose a bank, a Main Street bank in a community. But I saw that those were mostly anecdotes and there wasn't great data around that. Come the financial crisis, I observed Treasury's response, this is the tale of two treasuries, to the crisis and the things that they needed to do, but the lack of consideration and frankly good data and understanding of the value of the diversity of our system. And really that's summed up in what a lot of people refer to as too big to fail or too big to fail policies. You think about the response to Fannie and Freddie, the backstop, receivership, or conservatorship. You think about the decisions to back bonds, but not preferred shareholders, who that would affect. There really wasn't, you think of TARP and the early decisions and discussions around TARP and TARP approval, and the largest banks were assumed to get TARP, sometimes whether they wanted it or not, but there was a commitment to preserving the core of the financial system and a lack of appreciation for what the diversity provided. I think now to the Treasury Department that really led, it was an SBA program, but led the PPP. And I saw a great appreciation for and sensitivity to the value of the community banker at the outset of the program and then throughout, trying to make the program work for institutions that they thought would help deliver the results they wanted, based on the proximity of the banker to the small business to the borrower. Some of the research that we've seen today, and I really attribute that to research over the last 9 years that's talked about the difference that relationship lending makes the disproportionate in a positive sense, just like we heard about commercial real estate, to small business lending of community banks. That's been repeated a few times over the last couple of days. That has become much more common knowledge in Washington now. It wasn't a decade plus ago. So one of the things I really found interesting was the discussion, and we're in the early days of interpreting and understanding this, but of PPP and some of the findings about the incentives. It was interpreted for PPP lending was more about risk and less about profit. I think about the value of the conversations we have here, and I think about one that I was a part of yesterday afternoon in one of the breakout sessions. And I think that notion of risk to the bank, was really risk to the bank, risk to the bank's customer, and the bank's community. And we heard that today from one of the bankers. That connection between the bank, the customer, and the community at the local level is critical. I also saw that commitment that went beyond the risk to the bank and to the risk to the community, repeated in a lot of different ways. I don't think you have bankers staying up till 2 and 3 in the morning to process loans just because of the risk to the bank. There is some deeper commitment there, and something that we need to understand, because if we lose it, we may be losing something that's just critical to the fabric of our economy, our communities, our society, our democracy. So that's something that a big takeaway for me is, one, the work that's happened here in understanding the value of the community bank system continues to inform policy. It goes beyond small business lending, risk-based capital, and discussions about how and legislating risk-based capital options for community banks, HHI and debates about HHI, understanding accountability, what Chairman McWilliams talked about in terms of transparency. That was an issue featured early on in this conference about the federal appeals process and how that worked or didn't work, or in supervisory matters. So there's so many issues here that we hear about. I also want to highlight what was so encouraging to see the young students from the University of Tennessee at Martin, the winner of our case study, and the work they did to highlight TriStar Bank and its commitment to its community, understanding PPP lending, and the conversations they had with the bank about diversity, equity, and inclusion. That's a conversation that's happening all over the place, more than we probably realize, in community banks and their relationship with their customer. I also want to highlight the challenge that Darren Williams posed. One, he certainly exemplifies that dedication to community as a CDFI and a community of people of color, a community of LMI borrowers, and a challenge to the rest of us. Think how we support the American promise for future generations. So with that, I'd like to wrap up. I know we're heading in to our breakout sessions. I guess we're not allowed to call it a happy hour. So our almost happy hour coming up next. But I want to thank all of you, and I look forward to celebrating 10 years next year and seeing you all in St. Louis. Thank you.